Welcome to the Allan Small Financial Show. Welcome to this special edition, this Christmas Eve edition of the Allan Small Financial Show. I want to thank all of you for taking the time out of your busy day, and I'm sure it's quite busy this time of year, to spend a little bit of time with us. As always, we aim to provide as much information as we can. And during this special edition of the Allan Small Financial Show, we're going to take a look back at what 2025 had to offer all of us. It's sure been a pretty good year. There are our topics, but we're going to take a look back and we're going to take a look ahead as to what 2026 can offer many investors going forward. As you can see, here are our topics for this afternoon. Looking back at 2025, what were the surprises? What did I believe were the biggest surprises in 2025? We're also going to have a special dedication to all our guests that we've had on for this past year. And it's been quite a number of guests, some fantastic individuals providing some fantastic information for all of us. And we're going to play that right off the top of our show. We'll then move into top economic words frequently heard in 2025. Yes, these are your most famous and most heard words. Words such as tariff, artificial intelligence, to say the least. I think President Trump's favorite word has been tariff this past year. So we're going to go over some of the top words heard on economic broadcasts and our broadcasts over this past year. We're going to go to a bit of a different top three list. It's actually going to be a top 5 things to watch for 2026 for individual investors to consider before you make your investment decisions during this upcoming year. 5 things that I think you need to be mindful and to watch for. We're also going to talk about U.S. inflation. We recently had some inflation data out of the U.S. The inflation numbers came in well below expectation, and the market truly loved to hear or to see those numbers. Mixed U.S. jobs numbers. We actually saw some strong jobs numbers out of the U.S. We recently also received some strong GDP numbers, some growth numbers. And for all of you that are wondering, well, why are we talking about the U.S. data? Well, as we all know, U.S. data tends to move markets a lot more than, unfortunately, the economic data out of Canada. And yes, economic data out of Canada tends to move our Canadian dollar, but not as much our markets. Quick hits, 3 things that I've seen in the news, read about, and I wanted to comment on for all of you. And last but definitely not least, your questions on this abbreviated Christmas version of the Allan Small Financial Show. We're going to take at least one question from our audience. Please, if you have any questions during this telecast and would like to put them into the chat boxes during the telecast, we will be happy to answer your question on our next show or even maybe at the end of this show. So without further ado, let's move forward with a beautiful video with regards to our wonderful guests that we have had on our show this past year.
I want to address this. That really gnaws at me. There's healthy people. We have over 200,000 jobs available in Ontario. We need the healthy people to get their butts off the couch and get in there and start applying for the jobs. We need more productivity, not just here in Ontario. We need more productivity right across Canada. Sectors that we're looking at, obviously, the tech sector is growing at a rapid pace. And along with the EV sector, life science sector, manufacturing as a whole, and as simple as going, maybe you don't have that skill set. Go into an Amazon warehouse. They're hiring nonstop. They're hiring every single day. Get out there and work. Contribute to society. That's all we're asking.
We are going to lose in any protracted tariff war with the United States. And we're going to lose for one simple reason. Exports are about 3 times more important to the Canadian economy than they are to the US economy. And 3/4 of our exports are to the US. That's not to say that there won't be local pain in the US. For example, there's like around 15 states, their number one trading partner is Ontario. Okay. But in the aggregate, nationally, the Canadian economy is a much more trade dependent economy than the US economy. So, in any protracted tariff war, there's going to be more damage in Canada than in the US.
Longer term, and I think this is a good point, this moment has really reminded a lot of Canadians of the importance of getting economic policy right. Right? There's a lot of things that we can do to improve productivity, improve growth, improve labor market outcomes, improve the amount of income that's being generated, improve affordability, that we really haven't been paying a lot of attention to, let's say, certainly federally and to some extent in different provinces as well. And this moment has, I think, changed how Canadians think about policy and has caused us all to put more weight on economic outcomes.
I think we've had 20 tariff changes imposed by President Trump, 20 changes in the tariffs since this first started. And so, how could you, as a business owner, understand what's going to happen? I had one great example of this. A business owner was hustling to beat the tariffs, brought in extra staff to get his goods across the border in advance of the tariffs. He was shipping them out because there was a transportation delay. It was after midnight. As a result of crossing the border at midnight, he got a $35,000 bill for tariffs, only to have the president then remove those tariffs 8 hours later. So had he not hit that 8 hour window, he would have been okay. Instead, he walked away with a $35,000 bill.
No one in the market or the markets themselves are going to wave a white flag and say, hey, by the way, the market has bottomed. It's now time to get back in. And statistically, I don't have the numbers at my fingertips, but statistically, we know rallies happen very hard, very quickly, when you least expect it. If you exit the market, you lock in that loss. And then when things turn very quickly, some of the biggest gains happen immediately after we presumably hit near or at that bottom. I mean, if you're that nervous, you're not sleeping, maybe your exposure into the stock market was never right to begin with. And so that's a different conversation rather than trying to time the market, because you got to get it right twice, going out and, more importantly, getting back in.
There are, without exaggeration, Allan, trillions of dollars in the ground. Premier Smith said oil alone, all by itself, and there's way more resources in this country than oil. We've got potash, we've got nuclear, we've got trees, we've got agriculture, we've got critical minerals. She said there's well over $1 trillion at the suppressed price of oil today that is recoverable in the oil sands. We should become the natural resource superpower in the world. We've got the resources, and the whole world wants those resources.
It is an agnostic barometer of the intrinsic value of our fiat currency. No government can control it. No government can print more of it. And so it's just telling us that our fiat currency is seeing a debasement. And in fact, if you look over 50 years from when we abandoned the gold standard back in the early 1970s, the gold price has gone up 150-fold in that period of time. The purchasing power of our own currencies in North America have gone down about 99%. So it's a very linear relationship over that long.
I do think we need to take a look at where we stand. And I think tax cuts are probably part of the answer, not the only answer. I will say that the 1% tax cut that the federal government brought down is just a token. And I know that adding a $30, more to a Canadian's bank account every month through that is not going to change the world. It's not going to make much of a difference. They just want to be able to say they cut taxes, right? So it has to be more than just rhetoric. It has to be meaningful and targeted. And I won't get into specific ideas, but there are ideas out there.
What tremendous guests. I want to thank each and every one of those guests that we had in our reel here. I also want to thank the guests that did not appear in our reel. Amazing people providing our viewers with such timely and fantastic information, answering questions that many people have on their minds or have had on their minds during this past year. But I guess if you were to ask me, what has been the surprises for 2025? For me, I think they boil down to two. First one, market resiliency. And we actually have a chart that we can show, our one illustration for this segment. There it is. On the right-hand side, this S&P 500. Look at the dip that we saw back in April. S&P 500 down almost 20% at one point, only to rally. And now here we are, last week of the year, and markets are up. S&P's up somewhere around 17%. So we went from being down almost 20 to up 17, almost a 37% increase since the spring. How much more resilient could our markets be? And we always know the markets are resilient. They always climb that wall of worry. But this year clearly shows us just how resilient these markets have been. The second thing that has surprised me this year is the seasonal factors. There really hasn't been any. We look at September or August being weak months of the year historically. This past year, August and September were actually good months for investors. November, which is the strongest month of the year by far historically, was actually a weaker month. If you look at the chart there and you look at the graph along the left-hand side, you will see that September is normally red, November is normally green, but November, we had a blip in November. The market's S&P 500 lost almost 6% at one point in November, started to rally back after U.S. Thanksgiving, but it still had definitely a pullback, something that investors did not expect. And December has been an okay month. We've had a bit of a rally these last few days, but overall, December has not been the positive month that we normally are accustomed to seeing. So seasonality surprised many. I think the resiliency of the markets surprised many of us. I don't think anybody would have believed or imagined that we would see the gains that many had in their portfolios. So looking back in 2025, a fantastic year, fantastic guests, the Allan Small Financial Show. And once again, I want to thank everybody for participating and being on our show. You all truly made it a wonderful year. So I thought it would be kind of interesting to go over some of the terminology or even words that we frequently heard this past year. It's interesting. Every time we create a show, we produce a show, we could not help but always say the same thing. What's new out there? It just seems like we're always talking about the same things. And so I thought it would be kind of fun to bring those to all of you for this show. Two letters that we probably heard more often than any other letter in the alphabet was AI, artificial intelligence. How much did we talk about artificial intelligence in 2025? NVIDIA, the king of artificial intelligence, largest company in the world, largest chip maker in the world, the company that drives AI. How much did we talk about them? We talked about the Fed quite a bit and how much the president of the United States was not happy with what the Fed has been doing. Tariffs. How can we not talk about 2025 without the word tariff? We all know that tariff is President Trump's favorite word. We actually have our first kind of a illustration here, which a bunch of headlines talking about some of these words. Here you have AI dominates 2025 words of the year. This isn't the first time the Fed has struggled for independence. How investors buy gold and what fuels the market. Gold, another popular word in 2025. The headline at the bottom there, NVIDIA stock rises on report of new chip sales to China. Canada-US trade tensions. Trade was a big word. Trade and tariffs seem to go together. And I guess the one at the top here was editors vote for Trump's tariffs as the Canadian press news story of the year. So interesting bunch of words. And as I'm sure all of you would agree, we heard these words many, many times throughout 2025. Our next illustration or chart goes into some of these words. There's trade uncertainty spiked this year. U.S. Categorical Economic Policy Uncertainty Trade Policy Index. You can see here the spike in uncertainty and then the coming down of uncertainty as we kind of got into mid-2025, somewhere around May, June, and then things just started to come down. So definitely a great chart to show the uncertainty this past year. Our next chart shows AI and how interesting AI has been. The use of AI by respondents, organizations, percent of respondents or organizations that use AI in at least one business function. And you can see how much AI is being used by businesses today. More and more, we're starting to see not only large businesses use AI, but mom and pop shops, small businesses using AI as well. Our next chart here, what we have is one on tariffs, I believe. Average effective tariff on exports to the US by province. And would it surprise you that Ontario was affected most by tariffs? I don't think it would. Obviously, some of the smaller provinces may not be affected as much. Alberta, which sends energy down south, tariffs on energy were always set at lower amounts. And I think that's because obviously the US needs the energy that we produce. Whereas Ontario, we have the automobiles, we have the steel, we have the aluminum, we have the copper. And so no wonder that the largest bar on this bar chart is the province of Ontario. The Fed, we heard a lot about the Fed. Our next chart shows the three top candidates that we have right now to take over from Jerome Powell to be the head of the Federal Reserve in the new year. And obviously, President Trump is looking to have a Fed be a lot more dovish and looking to have more interest rate cuts in 2026. You can see Kevin Hassett, White House economic advisor, so he already works under the president. Christopher Waller, he is already a Federal Reserve governor. And Kevin Warsh, former Federal Reserve governor. These are the three, I guess, candidates that everybody's looking to replace Jerome Powell. But the Fed, extremely important. And obviously, we heard a lot about the Fed this past year. Our next chart, we move over to gold. And it's an interesting chart, not so much a look back, but a look ahead. And these are predictions by, I believe, JP Morgan. Will gold break through 5,000 an ounce in 2026? Well, you can see there, they believe that it may in the fourth quarter, but it'll probably take the full year to do so. Drop down, I guess, for the first quarter, or sorry, go a little bit higher for the first quarter in 2027. So if you look out for where I guess gold will be at the end of 27, they're predicting that gold moves a lot higher. And last but definitely not least is our, I guess, NVIDIA stock or corporation. It has been probably the most talked about stock, I guess, in the world today. Most talked about company in the world today. Largest company by market cap, $4.5 trillion and rising. It had a bit of a dip recently, but has since moved higher once again, $185 to $190 a share in that range. And perhaps once it goes over 200, because I believe it will, it may even regain its $5 trillion status. And NVIDIA today is worth almost 10% of the S&P 500 on its own. And a lot of people thinking, is this a bubble? Is this going to burst? I don't think so. NVIDIA to me actually is cheaper today than it was a year ago. That's how fast they are growing earnings. Can NVIDIA stock pull back? Sure, but I don't think it's going to pull back because of it's in a bubble. I just think that's what happens to businesses. At some point, they do have a bit of decline, and then that decline is followed by a surge higher. So NVIDIA has been in the news and talked about quite a bit in 2025, as well as a lot of the other things we just mentioned: AI, trade, the Fed, gold, tariffs. These were the top words in 2025. We'll have to see what 2026 brings and what words are spoken most in the near to come. Top 5 things to watch in 2026 for individual investors before you make your investment decisions. I think for this market to continue to go higher, we're going to have to see AI and technology companies still have momentum to the upside. I think they're still going to have a good year for this market to continue to ride the wave higher. I don't think there's any doubt about that. A lot of people are saying that the markets now are more balanced, and maybe they are than a little while ago, maybe 6 to 12 months ago. But make no mistake, AI or technology in general makes up the largest component of the S&P 500. Almost half the S&P 500 is technology. Trade pitfalls. What could happen? Well, we know USMCA, or CUSMA as we call it here in Canada, is up for renegotiation. I have to believe that trade negotiations between US, Canada, and Mexico will dominate the talk in the first half of next year. Fed Reserve being dovish. We touched on that last segment. I think the Fed's going to have to remain dovish. Perhaps see as many as 2 interest rate cuts in 2026, or perhaps maybe a few more. Potential market risks. Now, this was something that Deutsche Bank came out with, and they listed a bunch of their risks for the market in 2026. I thought I would bring some of those to you as part of our top 5 list. And our last one, normalized returns. I think individual investors need to keep in mind that returns will be a lot more normalized, in and around 8 to 10%, closer to 8% on the TSX, closer to 10% on the S&P. I think that should be the expectation for individual investors. So let's go on with our first one, AI and tech momentum. A great picture there. Our first chart talks about how AI has pushed tech stocks ahead of the pack. You can see here the S&P 500 has done extremely well, but look at tech. Look how well tech has done. And as I said, I believe that tech has to continue to do well for the markets to continue to do well, especially considering tech makes up 50% or maybe a little less, maybe closer 40 to 45% of the S&P 500. And, for the markets to continue to roll, I think names like the Mag 7 and others, the Broadcoms of the world, the AMDs of the world, some of the other older names that we've talked about for many years prior to the last 3-4 years, like an IBM, like a Cisco. I think these are the names that are going to continue to do well, especially if we want to see the S&P 500 surge higher. Our next topic, or our next on our list of the top 5 things that need to go right for the markets and that individual investors need to focus on, we have trade pitfalls. And as we said, there you have it. You have Canada, US, Mexico, and the big word trade underneath. Our next chart here shows how America views of NAFTA and USMCA. You can see there, overall, do you think the US, Mexico, Canada free trade agreement, what do you think of it? And you can see here, well, once upon a time, it was called NAFTA, North American Free Trade. Now it's called USMCA. And is it good or bad for the US economy? And you can see different parts of the, of the population. Overall, Republicans, Democrats, Independents, but it's all coming in and around, let's call it 75%. And you can see here that 75% in general, of the population think that USMCA, or whatever they're going to call the trade agreement this year, maybe the same, maybe they'll change it. Everybody seems to think it's important. I know the president has said that he has no problem walking away if things don't work out, but I think many people believe that that is just a bluff and that he needs to have a trade agreement just like Canada and Mexico do as well. Our next point, number 3, that individual investors need to be focusing on and hope for is a dovish Fed. Dovish meaning a Fed that is looking to cut interest rates more than likely. We've had Jerome Powell and the Federal Reserve cutting rates a few times this past year, 2025. But what will they do in 26? Now, if you're sitting there wondering, well, yeah, if the head of the Fed comes in and he is dovish and wants to cut, he's only one vote. And you are correct. The head of the Federal Reserve is only one vote. The vote is tabulated with all the other governors giving or voting governors, I should say. There are many governors that don't have a vote this year. So the voting ones, they will tally up what they believe is the way to go, and we'll see what we get. But definitely, the head of the Federal Reserve is usually, or has the most influence usually. So it is quite important who the head of the Fed will be. Our chart here for this third point of the Fed, there it is. Talks about the target range for Fed funds rate. And you can see now that it is 3.5 to 3.75. Many believe that that could be as low as 3% by mid-year. And then we'll have to see what the second half of 2026 brings. The next, number 4 of our top 5 lists for 2026 that individual investors need to be mindful of. And these are the risks that I mentioned. And this is from Deutsche Bank. And they talked about potential risks that could happen to the stock market. There you have them. And the first one, tech valuations plunge. As I said, tech valuations or technology is so important to the stock market. 57% say that this is the number one risk to the markets in 2026. New Fed chair pushes for aggregate cuts and causes market turmoil. So they're saying if the Fed cuts too much, that could cause market turmoil. 27% have that as an issue or a risk. 22% say a crisis in private capital, too much borrowing by some of the businesses like OpenAI, the parent of ChatGPT. Bond yields rising 21%. Central banks hiking unexpectedly. That one you don't see a lot of. That one is the next one. And if you go all the way down to 10% turmoil in crypto assets, people think that that could be an issue at some point this year as well. So that is the fourth point that we wanted to touch on for our top 5 list. And last but definitely not least, number 5, normalized returns. And our next chart shows normalized returns. Return on investment. What should you be expecting from your investment? Should you expect another 30% year? Well, I don't think so. Here's the TSX returns for this year, 30%, greater than 30% returns on the TSX. Dow Jones, 14%, S&P 500, 17%, and the NASDAQ coming in approximately 22% gains. And this is following gains that we received over the past few years, which have been tremendous as well. So I think we need to ratchet down our expectations a little bit. I just don't believe that we're going to have the same kind of year as we've had this year and the previous 2 years. I think keep our expectations grounded, keep it more normalized in that 8 to 10% range. And I think that the expectation should be that. And if you have the right expectation, that should not lead you astray, and really should not lead to emotions, having these high emotions, maybe perhaps the emotion to get out of the market if things are going down a little bit, or perhaps buy when things are moving higher by quite a bit. You want to stay even keel as best as you can. And that's the job of an investment advisor, the job of myself, to keep emotion out of investing. So for me, these are the top 5 things that I think individual investors should be focusing on, and the top 5 things that I think the market needs to have another good year, another positive year in 2026. We had some pretty good inflation numbers out of the US, and I think they were quite surprising. And they actually were so good that I think a number of economists and a number of individuals were questioning the validity of the inflation data. Not often you see inflation drop from 3% down to 2.7 or 2.6, and that's what we received in the US. And perhaps because the government shutdown, over 40 days shutdown in the US, perhaps the data itself may not be as accurate as at other times throughout, but it's the data that we received, and it's the data that the market took. And on that day, the market actually surged higher when we received this data this past week. And, 2.6, 2.7 is a great number. Let's put up a chart on inflation. There you have it. So we had all items came in at 2.6, which is your headline number, and 2.7 is the inflation number. We call it the core CPI or core inflation number. That is subtracting volatile food and energy. So when you look at a number 2.6, let's call it as a headline, 2.7 core, getting closer to the 2% target rate. And when the Federal Reserve looks at that, does that give them opportunity or a little bit of ammunition to cut interest rates further in 2026? Well, I do believe they do. And I do believe that they will cut interest rates. And if they do, I'm just hoping that the Bank of Canada also considers cutting rates here in our country. I think that would be great to help stimulate our GDP, our growth here, which we just received numbers on in the last few days. And those numbers were actually quite slow. We saw a negative number a few months ago and a 0.1 increase for the most recent read that we're hearing about. And hopefully we do not have a negative read for Q number 4 or quarter number 4. So cutting interest rates in Canada, in my opinion, makes sense. I know the Bank of Canada did not cut this last meeting, but hopefully they will consider cutting. In the meantime, the US seems to be continuing to cut rates. Perhaps they don't cut early on in 2026, but with this inflation data, I think you can look ahead. And with a new head of the Fed coming into being in the spring, I believe it's in May that the new head of the Fed will take the reins, take the job. I think the market will be anticipating 2 rate cuts in 2026. So mixed U.S. jobs numbers. Interesting. We were expecting or hoping for, or the U.S. was hoping to see, the president was hoping to see some really strong U.S. jobs numbers. And what did they get? They had weaker jobs numbers. And again, it's a bit of a mixed jobs report. You couple that with a pullback in inflation. And what do you have? Well, you have a situation where the Federal Reserve will possibly continue to focus on jobs, job creation, which is one of the things that they focus on. As we say often on our show, the Federal Reserve has a dual mandate, and it's jobs and inflation or stable pricing that they focus on. Our first chart shows a month-by-month chart. There you have it of the jobs numbers. Pulling them up there. There you have it. We were up or positive 64,000 prior month, down 105,000 for October. Then even though, again, the government shutdown, tough to get a full read or an accurate read, but that's what they reported. A positive number in September and then a negative number in August. And you can see the flip-flopping that has been going on in the U.S. economy with respect to jobs growth. So something that the Fed obviously does not like to see, something that the President of the United States does not want to see as well. So President is definitely pushing for lower and lower rates. A lot of members of the Fed, including Waller, who we had on as a possible candidate to lead the Fed starting in April, or starting in May, I should say, starting in the springtime. He also is saying that they can continue to cut rates, but very measured and a very measured pace. So a mixed jobs report, weaker inflation. What does that lead us all to believe? We're going to see lower interest rates in 2026. And that, coupled with some tax cuts that were announced with President Trump's one big beautiful bill, no tax on tips, no tax on overtime. These are the things that many are hoping can help stimulate the economy, and with that, stimulate the stock market to another positive year in 2026. Quick hits, three things that I've seen in the news recently that I think we can comment on our last show for 2025. Big Canadian banks split on 2026 rate path. Now, this is the rate path for the Bank of Canada. Gold smashes past 4,400. Silver hits record highs as the rally moves on, as the rally continues to go higher, as interest rates look to be cut in the United States. A tariff exemption was Canada's salvation in 2025. It's absolutely at risk in 2026. And I think we can add there, it's absolutely necessary in 2026 as well. So let's go to our first quick hit. Canadian banks split on 2026 rate path. Will the Bank of Canada cut aggressively? Will they cut it all in 2026? Let's go to our first chart, and you can see some of the bank commentaries. Current Bank of Canada policy rate, 2.25%. What does the Bank of Montreal say? It's going to cut to 2% or even 1.75 in 2026. Scotiabank and National Bank actually have a hike to 2.75%. CIBC, RBC, and TD Bank are on hold. And I hope Scotiabank and National Bank are not correct. I think to see a rate hike, you're going to have to see this economy really start to take off and move higher. And I think that's going to have to be on the back of a new trade agreement, which we're going to have to see come the spring of this year. Our next quick hit that I wanted to talk about, and that is gold, and it is smashing through all-time records. And why does gold continue to move higher? Well, two reasons, mainly the anticipation of lower interest rates and higher debt levels in the US and all around the world. You have all these countries taking on more and more debt, borrowing more and more money, weakening their currencies. When you weaken your currency, that only strengthens gold, and especially the US dollar. As we know, gold is a hedge against the US dollar. Our chart for this quick hit is a chart of gold, which is now at all-time highs. It just went through $4,500 an ounce. Would or could that have been predicted? Probably not. If we had a chart of silver, you would see that pretty much moving higher almost in the same way as gold. In fact, silver has actually doubled in the past year, whereas gold is probably up about 70%. Both metals doing extremely well, both precious metals doing extremely well. Our third and final quick hit is one with respect to tariff exemptions and what's going to happen in this upcoming year. And I think tariffs, USMCA or CUSMA, CUSMA, will take center stage at the start of this year. Will Canada come to a trade agreement with the United States? I believe coming to an agreement with Mexico should be quite easy or easier. I think Canada and Mexico already have some agreements in place. The question now becomes, what will the U.S. want from Canada to get a deal done? They've already talked to us about dairy. They've talked to us about banking. They've talked to us about other areas that Canada currently protects with either no entry or higher tariffs. And the U.S. is wanting to bring those tariff walls down, or else they will increase tariffs on us. Our first chart and only chart for this segment talks about which countries rank the lowest with respect to tariffs. And what many people don't realize is Canada is the lowest because of USMCA, CUSMA, as we call it here in Canada. Most of our exports to the US are not tariffed. About 80% or even a little bit higher, 85% of what we ship to the US is not tariffed, or there is no tax applied to it, no duties applied. So many countries have negotiated agreements, trade agreements this past year. As we all know, Canada has yet to do so, but we already have trade agreements in place. And I think that's why our Prime Minister has not, come to an agreement as yet and has not negotiated one, because I think in his head, we already have one, and that one is pretty strong and doing quite well. I think the negotiations will have to take place and already are taking place for this upcoming year. And I guess time will tell how that all works out. So with respect to trade, let's all we'll all be keeping our ears and eyes peeled for the latest that comes out. And I guess we'll have to see how things shake out in 2026. What's my take? This is the part of the show where I take one of your questions from the audience, and this question came through over the past couple of weeks, and I have it here. I find ChatGPT very helpful for answering questions. Can I rely on it for investment advice? I thought I get many questions that come in over the past couple of weeks. Every 2 weeks, you get a bunch coming in, and I thought this was kind of humorous. At the same time, many people are probably wondering if they can rely on ChatGPT for investment advice. I guess the simple answer is I would say not or no. Sometimes you just don't even know if ChatGPT is even accurate. It's only as accurate as the information that it has in its database and stored. A lot of times you'll ask questions to ChatGPT or other models, whether it's Anthropic or whether it's Gemini or whether it's Grok. And I say there's still a number of times where the right answer is not given, or perhaps the answer is outdated. So no, I don't believe that anybody should be looking to ChatGPT for investment advice. All the do-it-yourselfers that like to invest on their own, that's great. I know there are a lot of great programs and software programs out there that can help you if you have the time to do so. The unfortunate thing about these programs as well is that when the markets start to go south, unfortunately, there's no one at the other end of the phone to take your questions and walk you through what you should be doing during the volatile times. When markets are going up, yeah, maybe it's easy to use some of these robo-advice type of shops or ChatGPT or whoever. But when times are difficult, when the markets are volatile and things are going down, that is when I believe investment advisors really earn their keep. So with that, I want to thank everybody for tuning in to the Allan Small Financial Show this past year. It's truly been my pleasure to come to you every 2 weeks at 12 noon on Wednesdays to bring you information, answer as many questions as I can, as we can here. All of us that produce the show, I have a tremendous staff, a tremendous crew behind me that helps me produce the show every second week. I want to thank all of you for helping me produce the show. It truly has been a pleasure. And I look forward to seeing all of you 2 weeks from today on January the 7th at 12 noon, where we will begin 2026. A whole list of new shows with new guests and some returning guests for all of you. So once again, January 7th, Wednesday at 12 noon across all social media channels. And as I say one last time this year, until then, happy investing.